Up next, we have an exciting Fireside Chat featuring Mr. Rajan Anandan in conversation with Mr. Vijay Thadani on fundraising in a difficult macro, understanding investors' expectations. We are honored to have Mr. Rajan Anandan, Managing Director at Peak 15 Partners and former MD Google India and Southeast Asia. With his vast experience in venture capital and scaling businesses, he brings deep insights into the evolving investment landscape. Alongside him is Mr. Vijay Thadani, Vice Chairman and MD of NIIT, who has been pivotal in transforming the education and skilling industry. We encourage the audience to participate by typing their questions in the chat box. Our speakers will address them at the end of the session. Without further ado, over to you, Mr. Thadani.
Thank you. Good evening, everybody. This is perhaps the most interesting part of the EdTech Summit because this is where the rubber meets the road. We are going to discuss how do you raise funds. In the previous discussion, we were saying you have to be brave rather than brilliant, but brave with an empty pocket is a little more difficult than brilliant with lots of money in your pocket. So brave with money in pocket is, I think, really the issue. And the Indian EdTech ecosystem has seen dramatic shifts in the past few years from pandemic-fueled hyper-growth, where everybody who thought they wrote EdTech in their resume on their card or in the matrimonial ad, they had a better chance at grabbing the future. To the current phase in which there is consolidation and focus on sustainable business models, which I'm sure Rajan will talk to us through. And we have a tech leader and a very seasoned investor. I'm hesitating to use the word veteran. Seasoned is perhaps the more appropriate term. And who's been a technology leader at Google and as an investor at Sequoia and now Peak 15 Partners. Rajan, before I get going, I've always been curious to say, how did the name Peak 15 come up?
Yeah, thank you, Vijay, for and team for inviting me. Great to be here with all of you. So Peak 15, Vijay, it was the fifth. It's basically Mount Everest. So before Mount Everest was named Everest, it was the 15th peak in the range in the archaeological survey of that range. So that's sort of what it is.
Okay, and Mount Everest it is.
Yeah, it's meant to symbolize the highest peaks that you can get to. So we want to help, we want to partner with founders who want to build the most enduring, most iconic companies on planet Earth.
No, wonderful. So well thought of. So how would you like to define the current economic environment, macroeconomic environment for fundraising? And the other winter is nearly getting over. Is this a funding winter, or it's normal times, or
yeah, it's a good question. Vijay, so this is business as usual. So I'll tell you, I think let's just use numbers because that's usually helpful. So if you go back to 2019, we were at about 10, 11 billion of annual funding. 2020 was COVID, so it dropped a little below 10 billion. And then we had two very unusual years that were driven really by this extraordinary, unprecedented liquidity around the world because of COVID, which was 2021 and 2022. So in 2021, we went from basically about 10 billion a year to 45 billion a year. And then 2022 was also quite elevated. It was about 25 billion a year. And then 2023 came down to about 7 billion a year. And 2024, I think when all the numbers settle, will probably be in that 12 billion type range, right? So we are back to sort of being in the run rate of, call it 10, 12, 13 billion range. And I think from here on out, it'll probably grow at, call it 15, 20%. So I think if you're an early stage company, it's important to keep in, when I say early stage, I mean seed, Series A, Series B. This is business as usual. I mean, it's not gonna, let's hope that we don't go back to 2021 because, that required the entire world to shut down because of COVID. This is sort of what it's going to be like. and it's very active seed market, very active Series A market, Series B market a little slower. I think what has changed is the growth market. And actually, it's changed because of a very positive dynamic, Vijay, which is the IPO market opening up for profitable Indian companies, right? Be they funded, venture funded or not. As you know, last year, India had 300 IPOs, 80 on the main board. In fact, on a number of IPOs basis, India had more IPOs than NASDAQ and the next two markets combined. And if you look at absolute dollars raised from IPOs, it was the second largest in the world last year after NASDAQ, after the US, NASDAQ and NYSE. So, in fact, I think there was about 20 billion of capital raised from IPOs last year in India. China's number was 9 billion. The UK was about 10 billion. So, so it's a and so what that's very positive because both for founders and for investors because it gives the ability to take a company public. You create some liquidity for your early investors and your employees. And then, you basically build like for the next 30, 40 years, much like you all did for many years at NIIT. Um, the negative effect of that is for growth investors. This is actually a very good thing for founders, by the way. For growth investors, what is if you're a late stage founder, you're trying to ask the question, should I now go public or should I raise private capital? And given the kind of multiples that companies were able to get, now that has changed in the last 3, 4 months. I think the long-term average PE has just dropped below 21, which is in the Indian markets, it's I think 20 point something now. But it was going to 24, 25 before, if you go back middle of last year. So if you put those two things together, really, there's never been a better time to be building a company, building a startup, raising capital in India because early stage, there's a lot of capital, it's very active. And late stage, if you can get a profitable company, as you know, I mean, if you can get to about 100 crores of EBITDA, you're going to have a very successful IPO on the main board as long as you're growing at 25% minimum and your consistent performance, right? You can't sort of you need to be able to predict what you're going to do, etc. So long answer to your question, this is business as usual, and it's a great time for entrepreneurs.
So I'm very happy you talked about the public markets. I don't think we even have a 2-digit number for publicly listed Indian edtech companies as yet. I would say it's less than 10 perhaps. Would that be right?
I think Vijay, I don't know what the number is. I think there are 30 venture funded. Now you don't have to be venture funded. As you know, most companies are not, but only about 30 or 35 venture funded companies that have gone public in India ever, right? But that number is growing by leaps and bounds. Last year, the number was 12 or 13. This year will probably be 20. So I think you'll see that happening. I mean, as you mentioned, even in your opening, I think because of the large amounts of funding that went into lots of sectors, including edtech, right? The profit priority didn't exist, and you can't really list in India unless you're profitable. Yeah. So that's a big difference between here and the US. In the US, you show a path to profitability, you can list. In India, it's much harder. I mean, Swiggy did it, but they sort of said they'd get profitable in a year, right? I think the only company that is listed without a very clear line of sight to profitability is actually Ola Electric. And that stock, I mean, it's a very, 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 very good company, but that stock's been a bit challenged because of that.
Right. And
so I think that will change. My view is that picture of how many, and by the way, I actually, from a startup standpoint, like ed tech is not a thing anymore. So I mean, basically, as investors, we're looking for education companies. Some of them are deeply technology enabled. Others have a light technology angle. So I think ed tech. I mean, we haven't talked about an ed tech company in about a year and a half. So first big thing is don't position yourself as an ed tech company. By the way, if you're a tech company, education AI is very interesting, but needs to be a native AI, native AI education company. That is very interesting. So today is really about education.
No, I think this is a very interesting point you read. EdTech has to go out of our vocabulary. It's actually a bad word to use now. And in sentences.
I would not use EdTech. I would not use EdTech.
Yeah. So Raji, we have to change the name of the Growth Summit.
Yeah, just call it like innovation in education,
Yeah.
Like it's really innovation, right? You could have innovative offline formats, you can innovative schools, innovative pedagogy, innovative technology. Correct. It's really about innovation in education, not necessarily, a lot of it will be, of course, enabled by technology. But I think this idea of pure play tech companies, I think some of them will come back. Like there'll be a new wave of companies that are AI first, etc. Actually, about a month ago, we were evaluating a very, very interesting AI education company in India. But anyway, that's just parlance. And by the way, it changes every couple of years. So you just have to sort of, especially if you're fundraising, you just have to know like what are some terms you probably don't want to use.
Yeah. So that's a good segue to the discussion that was happening in the previous chat also, I mean, that you heard, where I think we were looking at how AI has a profound impact. And we truly believe in NIIT and in NIIT University, we're doing a lot of work there, that AI has a very, very huge potential to actually disrupt education the way it has been taught over centuries. And there are some models which are doing that. I wanted to understand, and you just mentioned that, I wanted to know, how do investors look at AI? And the word AI is a very nice thing to add to anything. I have a car, it is an AI-driven car. I have an education model, it is an AI-based, AI-enabled, AI-driven. All kinds of words are being used. I'm sure there is a hype and then there is a reality. And I heard you talk about AI native AI based education models. I think are the ones that you folks look at carefully. So talk to us a little more about that, and how do you evaluate when you hear the word AI along with the description?
Yeah, I mean, I think it's a good question. Firstly, by the way, if you look at the AI stack, Vijay, right, there's, at the bottom of the stack, you have GPUs, right? So think about companies like NVIDIA. Then you have sort of the cloud providers who play in it. Then you have the foundation or the frontier model companies, OpenAI, Gemini, etc., Anthropic, and so on. And then you have sort of infra tooling companies. And finally, you have the application layer, right? So when we talk about AI education companies, we're really talking about application companies, right? They leverage many models. Usually now this idea of only building on one model is sort of dead. So they will leverage many models, and now many of those also agentic companies, which founders who are obviously building in AI know exactly what I'm talking about. So I think the way we look at this is to say, okay, let's just take some examples, right? Let's say the EdTech 1.0, Vijay, or maybe it was 2.0, I don't know, but this whole idea of live 1:1 lectures, okay? As you know, companies generate a lot of revenue doing that. So let's say let's say your primary offering is a live tutor doing one-to-many online. And let's say you're using some AI tools to summarize what the students are saying and maybe doing some basic responses. That is not a native AI company. Okay?
Yeah.
Native AI company is, let's say, an AI tutor. This, by the way, the technology isn't there for the vision I'm just about to give, but I think in the next year we'll get there. It is an AI tutor, right? Literally, it is not a human. It is teaching one-on-one, and it's highly personalized. So it is truly, I mean, that, by the way, that vision is probably 12, maybe 18 months away. The only reason it's not there now is that AI tutor, there's a bit of latency, and, it may not be able to hold for 2 hours back and forth, etc. Right? So that's an AI native company, right? So for instance, this company that I was referring to, that we met a couple of weeks ago, which is very interesting, they use, number one, AI to make video content. So far, about 50% of their content is delivered by a human, but all the material, that they use is developed by AI. But 50% of the content is actually delivered by AI. So it's almost like, this is AI this is Rajan AI talking to you, not the human AI. Although Vijay, you never know these days. It might be the AI Rajan, you know.
How do I ensure
Actually, you
that
don't
this
know.
time
You don't
not?
know. That's the whole point. Actually, in a year, I think within 2 years for Vijay, I mean, certainly we can have this. We will be having this chat, and it will actually be my AI because you know, like the tech will get to a point, and maybe it won't have as many, you know, sort of expressions of my hands and so on, but so on. So I would say, like, let's take, you know, like for instance, right? If you're not doing, you know, deep one-to-one personalization on a real-time basis, that's not a AI education company, right? Because that is the basic sort of things, right? And then are you using AI in every part of your, you know, quote unquote value chain, right? Content creation, pedagogy development, you know, et cetera, et cetera. Maybe pedagogy is not driven by AI. So that's sort of the way we think about it, right? So for instance, you had two primary models in EdTech 1.0. One was the one-to-many live classes, that is not AI. The second was recorded content delivered to individuals that really didn't have any personalization or interactivity, and that is not AI either, right? So you could imagine a one-to-one model where the content is developed with AI, and you know, you start with 10 or 20% AI, and then you kind of go to 100, you know, whatever, maybe not 100%, but 80% AI. But then the content is delivered to the student. Let's say it's video content, right? It's video combined with some audio and whatnot, but it's very interactive. I think this idea of highly personalized is probably the single biggest thing, right? Which is, at the end of the day, that's what you should be able to do, right? If I have a, I believe, Vijay, that the world's most advanced AI tutor will be built in India, not because we have the best AI talent yet, because we have the biggest need. We have the most acute need. I mean, as you know, right? We have 250 million students in K through 12. We have another 40 million in higher ed, and we just don't have enough teachers. We don't have enough schools, and so on and so forth. So I know it's a long answer to your question, but that's sort of how we think about. So we can look at a business very quickly and say, even if the founder is saying it's an AI company, okay, they're using some AI tools, but it's not really a native AI company, right? And by the way, to build a real native AI company is really hard. That's not easy, right? So the founders who end up doing that, I mean, we did invest in a Berkeley PhD. He came out with a PhD in computer science and AI at Berkeley, who's building a global, India is one of his markets, but it's not like the primary market, where he's building, for a certain kind of test prep. I mean, it is entirely AI driven. And when we look at the results that they're able to, like the outcomes that they're able to deliver, it's a very early stage company. It's very good, right? So let me pause there, Vijay. I hope that brings it to life.
Yeah. So my question is, a person who has a vision for a native AI model over a period of time, because the person will have to come with lots of money for him to even think that native AI is a possibility. So would you also encourage somebody who has the potential to move from let's say, using it in content development or personalization or in some other form, for example, being an assistant to the teacher rather than a direct tutor?
Yeah, terrific. I mean, that's a co-pilot. Yeah, absolutely. I mean, you could build different. And I think the thing that a lot of people get wrong, Vijay, today, to build a very powerful AI application actually doesn't take a lot of money. Because the big money is spent on training the frontier models, etc., right? That's the 500 billion Stargate project, although, DeepSeek showed it can be done for a few $1 million by distillation. So I think the key thing is it doesn't take a lot of money. It requires a very deep domain understanding, right? How does it really work? What are the workflows, et cetera, et cetera. And then it does require an understanding of the AI technology and being able to code an app, right? And work through, how do you work with different LLMs and how do you fine tune them? So what you need is good AI knowledge and you need good domain expertise. You actually don't need capital. You need some capital, but it's not really a lot of capital, right? I haven't really put this to test yet, but my hypothesis is if you have a very high caliber team, somebody who understands the domain, somebody who's very good at AI, who's built and shipped AI products. I bet you, like, Google or AWS, GCP, they give you $100,000 or $200,000 credits. You can probably build something and get it up and running, a basic version. And I think that is the beauty of all these billions of dollars that have gone into these models, both the closed models like OpenAI, but also, the open source models like Llama and now DeepSeek and many others like that.
Yeah.
It's not very expensive, but you do need deep technical expertise. You don't need a PhD in computer science from Stanford, but you need enough working understanding of AI, of how agentic, sort of, you need to kind of know that stuff, but not as much capital.
No, I think that's a very relevant and good comment, because that should provide a lot of encouragement to guys who have the brains but not the wallet as yet, or access to the wallet. So at least there is a very strong hope. Let's just shift. What do you look for when you look at a potential investee? Somebody comes to you with a pitch. What are 3-4 things that you look for? This will be very useful advice for the 200 odd people that we have on this, who are listening to you at this point of time.
Yeah, I think, look, it depends on the stage, Vijay. So if it's a seed stage company, just to give you a sense, 30% of our firm, Peak15, our seed business is called Surge externally. 30% of our seed stage investments, there's not a single line of code written. We're basically building on a founding team or a founder and a market that we like. Another third is maybe they've launched something that's got a bit of traction, etc. So seed stage, and I'll come back and talk about that. Series A is different, Series B is different. So what we look for is different by stage. Across all of those, we look for strong founding teams that have deep domain expertise, that are very insightful, that we think are going to go at it for 10, 15, 20 years to build a company. At seed stage, what we're particularly looking for is really the bet is on the founding team. And we're trying to say, okay, is this market interesting? Do we think a big company can be built, right? So let's say an AI and education company came and pitched to us, and they had a deep domain expert who comes with a very deep understanding of some sub-segment of education. But the co-founder, who's sort of the AI guy or gal, was not deep. We would not invest in that company, because, somebody else will out-execute them, because this stuff is moving really quickly, right? Now, if they've launched and they've got some early traction, we would look at sort of the early traction to say, look, have they built a product that people like? Do they use it? Are they continuing to use it? We look at engagement, things like that. So that is at seed stage. So it's largely almost entirely a founder bet. Then at Series A, so by the way, seed is, call it, a couple of crores to maybe, call it 25 crores, okay? Or maybe 30 crores. That's seed. That's the range, the very broad range, depending on the caliber of the founding team, what stage you're in, how much you've made progress, etc. At Series A, which is, call it 50 to 100 crore round, we are looking for, again, the same thing, which is a great founding team, etc. But we're looking for product market fit. So if you don't have PMF, you're not going to raise a Series A, okay? Not in today's market, and not in, well, if you're like a really, really hot AI team and, you have a little bit of early traction because there's so much interest in AI, you still might raise it, but otherwise generally not. At Series B, you want PMF and you want an economic engine. What I mean by that is, let's say you're building an AI thing and you got great usage, you got great retention, but your revenue model is still very early. That's okay for Series A, but not at Series B. At Series B, you want to see that there's a way to generate revenue, the gross margins are strong, the contribution margin, even if it's break even, you can see it getting to positive, etc. So I would say Series C and beyond, it's about an economic engine, it's about a business model. And by Series D, there's really no appetite for companies that lose money, right? So I'd say that is the way, right? So you start at seed with the founder and a story, to then product market fit in Series A, and then Series B is really about an economic engine.
Okay. We could have gone on and on, but the minute I see Neha, I know there is somebody going to stop us in a few minutes. I do want to touch two small things. One, how should the founders navigate a conversation with the investors? So if a founder walked into your room, how would you expect him to present himself or herself? I mean, we always use the word himself. I think we should do many more ourselves.
Yeah, ourselves, yes. Look, I mean, if it's the first meeting, I would, I think the introduction is really, really important, because that is what will give people a sense of, is there a reason why this founder or this founding team could win in this market? So, but the other thing though is, don't drag on for 10 minutes, because, like, keep it to 3, 4, 5 minutes, but say the things that are relevant in your background, that make it interesting and like superbly clear why your founding team is the right, has the right to be winning in this market. So I think that is one. I think second is just, well, firstly, just never be late. Try not to be late. Because if you're late to the meeting, it's unlikely you're going to build a company.
You're late to the market anyway, then.
Yeah, right. So I mean, I've always said, right, if you're late to a meeting, there's no chance you're going to build a company. But other than that, look, I would just look. I think there's a playbook of great decks. I mean, like, for instance, you can go online, you can do a search for Surge, and you can get those decks. Just knowing how to tell the story, there's a sequence that kind of works and so on. But really try to come across as somebody who's deeply insightful. See, you have to sell the problem, right? A lot of people just go right in to telling me what the product is or the service is or the solution is. That is a bad idea, because I don't know what the problem is, right? Like, don't assume that your investors now, of course, if you're going and talking to a fintech investor and they've done 25 fintech investments, of course they know what the problem is. But still, it's always the best founders sell the problem more than they sell their solution. Because if I can hook you on the problem and make sure that it's okay, wow, this is like a really huge problem you're trying to solve, and now you've got insights about how you're going to solve the problem, then I'll buy the solution, right? Like, say, okay, fine, yeah, I'd say that's what it is. And then last thing I'd say is, look, just say it like it is. People try to make up stuff. I mean, look, we do this for a living every single day, So when a founder tries to make stuff up, it's just like, we can see it like that. And keep in mind, whatever you say, the investors are going to remember when you show back up 6 months later. So we'll have, because, we track companies, okay? So, we have a lot of founders which will come and say, hey, look, I'm at whatever, let's just make up a number. I'm at 5 crores of revenue. Next year, we're going to be at 12 crores of revenue. And the year after that, we're going to be at 18 crores, right? They come back a year later and they're at 7.2 crores. I mean, this is not a company. I'm not going to invest in this company. Now, I don't know what happened. I don't really care, because you said 12 and you ended up at 7.2, So, and this is what people don't remember, is that investors remember, and actually they write stuff down. We have a database where we go and say, what did these guys tell us? Because by the way, it is a great signal. It is a great way to figure out whether a team is on top of things, right? Of course, you can only come, and also, by the way, don't commit these things if you don't have product market fit. If you don't have product market fit, you have to just keep iterating till you find product market fit. But I hope that's helpful. And keep in mind that either there's an intellectual element to investors and there's an emotional element to the investor. The best founders just build tremendous emotional excitement. Like, for instance, if you have no energy in your pitch, boy, it's just hard. I mean, your investors just can't wait for the meeting to end. Like, if you're you have no energy, why? Like, why on earth do I think you're going to build a company over the next 20 years?
These are phenomenal insights. I don't think any class would teach us this, or any course would teach us this. Rajan, really, really, very, very thanks. Many, many thanks to you for just being available and speaking from your heart. And I think the last 3 or 4 insights that you gave were truly good. I'm also wondering what we did 43 years ago. At that time, I don't think investors were as discerning as you are. And we maybe got away with lesser things. But I think the emotional part of your pitch has to be very, very high, a very deep commitment and conviction in what you are doing. So thank you very much for sharing your insights. I think the good news is, number one, it's business as usual. I heard you say it's business as usual. Second, just attaching the word AI is not going to solve the problem. The third, native AI does not. A native AI-based thinking needs more brains than brawn, and therefore, if you can demonstrate the brains, then the money is available, and I think it can be funded, and it doesn't cost a lot of money. And the third is that you have to be you have to be there at the right time with the right pitch and the right emotion. And I said, you value the problem more than the solution that he's building. I think those are some very, very useful things. So very much like we said, if you are late for the meeting, then you don't have a chance. If you don't end the meeting on time, then I don't have a chance further in dealing with Neha.
Yeah, Vijay, I'll wrap on this. I had a big change I made to my calendar last week. I used to have these 30-minute meetings. I've now moved to 15-minute meetings.
By the way, I've heard this as well. I've heard this in one of the companies my daughter works, and she says all meetings now start at 5 minutes past the hour, right? And they finish at 20 minutes past the hour.
Yeah, 15-minute meetings. Because I think most things can be, like, unless you have to, like have a long alignment meeting, lots of people disagreeing, etc. Otherwise, actually, most meetings are useless anyway. But like, if you're going to meet, because, like, you could just send an email update or whatever, right? Like, do a WhatsApp, what do you think, kind of thing. All right, Vijay, well, thank you so much for having me.
But this was not a meeting. This was not a meeting. This was an interesting conversation.
No, this is
thank you very much.
I'm not talking about I'm not talking about this. But Vijay, thank you for having me. I think for founders who are building, wish you all the very best. Look, it's just a phenomenal time to be building, right? Just make sure that you have a value proposition that students love, that they're willing to pay you for, and then they keep paying for. And it's very simple, really. I'll end with this, Vijay. I always say, like, look, the math has to work. If the math works, you're going to build a great company. If the math doesn't work, probably not. All right, thank you.
Right. All right. Thanks a lot, Rajan. Thanks for your time. Bye-bye.
Thank you for a truly insightful and engaging exchange of ideas. It